Great, more than halfway done here. So second to last topic here on our review, zero cost portfolios. And when I'm talking about zero cost portfolios, think of putting together a portfolio where you think there's some assets that will go up, so you buy them. There's other assets you think will go down, so you short them. And I'll tell, kind of just in a second what I mean by short. Okay, so in the investments class, we're occasionally going to look at zero cost portfolios. Okay, the zero cost portfolio is where you kind of short an asset. So you borrow a stock that you think is going to go down. You take the stock, cash it out right away, take the money that you've kind of borrowed by borrowing this stock, invest it in another stock. Okay, and you hope over the next year the stock you invested in goes up relative to the stock you borrowed, which is, you hope has gone down, and then you can make profit over this difference in return. Okay, I hope this doesn't sound too confusing. I think a little example will make this kind of clear. And I don't know if you're a big Toyota fan or General Motors fan, so I set this up as an example where I think Toyota's always going to outperform General Motors. If you don't like this, then just switch the example around. So I, as an investment manager, think Toyota is going to do better than General Motors. Okay, so what's the zero cost portfolio? We're going to long Toyota stock. Okay, we're going to short General Motors stock. So when I short General Motors stock, that's a financial transaction where every dollar GM falls in price, that's $1 of profit for me when I'm shorting it. But every dollar General Motors goes up, that's $1 I lose. It's the exact opposite of buying. So think of shorting is the negative of buying the asset. Now when I'm going through this example, I'm going to abstract away from margin requirements. In the real world, if you want to short an asset, you need to have a certain balance of collateral available at the brokerage house so they can be sure. For example, if you wanted to short Google after their IPO and Google's stock price has gone up a lot, you lose money if you would have shorted Google. So the brokerage house just wants to be sure that they have enough, that you have enough collateral on hand to cover any losses you may have. But we're going to ignore margin requirements for the purpose of this example. So let's look at the implementation of the zero cost strategy. So step one, borrow $1 of General Motors stock. Just like you're borrowing money, in this case you're borrowing $1 of General Motors stock. Right away you sell General Motors because you think it's going to go down, and you take that $1 to invest in Toyota. 1 year later, this is a 1-year strategy, so 1 year later you sell your Toyota stock, take the proceeds from the sale of Toyota, then you have to buy back the General Motors stock to return to the person that you borrowed it from. Okay, so what's the return of this strategy? It's simply the return on Toyota minus the return on General Motors. So remember, we're thinking Toyota is going to do better than General Motors regardless of the state of the economy. You don't know whether the economy is going to boom or be in recession, but regardless of what happens, Toyota is going to do better than General Motors. So we do this long, short Toyota General Motors strategy. So no money up front for this because that's why it's called zero cost, because the money that we needed to invest in Toyota, we got by borrowing General Motors. Now again, this is excluding the margin requirement. Okay, so let's actually just go through example here to illustrate how this would work. You can think of this as kind of like a very simple hedge fund strategy, as you will. We don't know whether the economy is going to boom or bust. So let's say in a good state of the world, our forecast is Toyota goes up 40%. And General Motors goes up 20%. The return of our zero cost portfolio is our General Motors goes up 40%. Let's do that. Goes up 40%. So our initial investment goes from 1 to 1.4. General Motors also goes up, doesn't go up as much. Okay, so initial General Motors value goes up to 1.2. So at the end of the year, our Toyota goes from 1 to $1.40. We'd love to keep the full $1.40, but we remember we've got our Toyota purchased by borrowing General Motors. So we have to cash out Toyota, take $1.40, then we have to buy General Motors stock back to return to the person that we borrowed it from. Now the General Motors is 1.2 instead of 1, so of the $1.40 of Toyota, we get to keep 20 cents. Okay, but that's not bad because our initial investment was 0 and we get 20 cents at the end. So now let's consider a bad state of the world example. So in the bad state of the world, again, we don't know if it's going to be good or bad, but whether it's good or bad, we think Toyota is going to outperform General Motors. So in the bad state of the world, Toyota falls 10%, General Motors falls 30%. Okay? Now, of course, if we knew it was going to be a bad state of the world, we would just kind of short General Motors. We're not going to invest anything in Toyota because it's falling in value. But the point is we don't know if it's going to be good or bad. So what's the return of the strategy here, the zero-cost portfolio? Well, our initial $1 investment in Toyota falls to 90 cents. So we're not happy about that. But remember, our General Motors that we borrowed has fallen even more, right? It's fallen to 70 cents. So the dollar we invested in Toyota, it's gone to 90 cents. We can't keep this 90 cents because we need to pay back the person that we borrowed the General Motors stock from. General Motors stock, those only cost 70 cents because it's fallen 30. Now it hasn't fallen, let me erase this here. I was kind of getting ahead. This is the Toyota fell 10. The General Motors fell 30. Toyota fell 10 to 90 cents. General Motors fell 30 to 70. You take the difference of the two. Again, that's a return of 20 cents. So this is a very valuable strategy. If your prediction is correct, that Toyota always outperforms General Motors, regardless of the state of the economy, whether it's good or bad, you get a positive return from this. So this would be the classic hedge fund strategy. In this case, we've hedged the macroeconomic risk. Now, throughout the course, we're going to be looking at a lot of these zero-cost portfolios. It might be stock market return minus the risk-free rate, small stocks minus big stocks, value stocks minus growth stocks. So we're looking at differences in returns, just like we did with this example, the difference in return of Toyota relative to General Motors.